Hello, welcome to the Credit Compass, your guide to navigating European credit markets. Each week we unpack key developments in credit, explore the macroeconomic forces shaping the landscape, and dive into the strategies that matter most for investors across Europe and the UK. This week we will cover the new EU-US trade deal. It is a deal that has a degree of controversy to it and faces some challenges going forwards. But for now, there is at least comfort that both markets have averted worse. On the UK side, even with an arguably better deal, there are some conflicting signals about progress over the summer. Lastly, the EU regulators have completed their proposals for changes to the securitisation regulations, with the final leg of adjustments to insurance investors' regulatory treatment of the sector. All right, let's kick things off. We have a deal. At least the start of one, anyway. The EU and the United States have agreed a heads of terms on trade that replaces Washington's threatened 30% blanket tariff with a 15% duty on most EU goods starting on the 1st of August. That is only marginally below the 20% rate announced on the 2nd of April, but it is far below the worst-case scenario and has eased the immediate threat of an outright trade war. Markets initially struggled to price the news. Monday opened firmly risk on before sliding to risk off in Europe, and that whipsaw tells you there will be clear winners and losers. So let's start with what's in the agreement. Remember, this is an outline and not a legally binding treaty, and it still requires approval from all 27 EU member states. A tall order given the early pushback that some capitals have shown to the Commission President Ursula von der Leyen's agreement. In particular, French and German governments have reacted with disappointment. So let's start with the tariffs. First of all, there's a 15% universal tariff on a broad range of EU exports, still to be finalized. There is a 0 for 0 tariffs on a targeted list, specifically aircrafts and parts, selected chemicals, generic pharmaceuticals, semiconductor equipment, certain agricultural goods, plus some raw materials. Steel and aluminum remain subject to the 50% rate. There are some strategic commitments to this as well. The EU will make $750 billion of strategic purchases from the US over 3 years, principally energy and semiconductors. And the European corporates will invest $600 billion US in the US over the same horizon. Most of this was already in the pipeline, though. So let's begin on the impact by sector. For starters, the new tariff is a reprieve from the feared 30%, but it still represents a material burden. Volkswagen and Stellantis noted in their second quarter earnings that the tariff will hit margins significantly. The change does, however, bring relief from the previous 25% rate and provides more predictability for planning and pricing. There is a silver lining in that zero tariffs for aircraft and their component parts, which should protect critical aerospace manufacturers across the continent. Still, 15% is not trivial across the board. It is above the UK's 10% and introduces friction at a time when the EU economy is just emerging from a growth trough. JP Morgan and Deutsche Bank estimate the deal will shave 0.1 to 0.2 percentage points off euro area GDP, half the estimated hit under a 30% scenario. On energy, EU imports from the US were $75 billion in 2024, already a record, but still just a fraction of the $435 billion of total energy imports to the EU. Tripling that US figure by 2027 would mean a substantial pivot away from other suppliers, notably Russia, and a significant build-out of import infrastructure. Therefore, this $750 billion commitment will require clarity on pricing and logistics. The $600 billion EU investment in the US is less dramatic than it sounds. Much of it comprises existing capital spending by large corporates, and officials described it as planned commercial investment, suggesting limited incremental pressure. The key carve-outs still to be finalized, though, include high-end spirits from France and Italy, which account for 68.7% of EU spirit exports to the US, dairy products that could face stiffer tariffs unless negotiated down, and pharmaceuticals still tariff-free for now, but could face duties up to 15% if talks fail. In terms of the impact of tariffs, Germany's share of EU exports in machinery and transport equipment dropped to 39.6% in May, down from 44.9% in February, just before the 25% tariff took effect in April. With that rate now reduced to 15%, European automakers gain some relief, but the question remains as to whether they will recover going forwards. The Financial Times suggests Mercedes-Benz, Volkswagen, and BMW expect a collective €10 billion hit to free cash flow in 2025. Why? Well, suppliers are passing on higher input costs, not just from external sourcing, but also from tariffs on raw materials like steel and aluminum. Rising unit costs are outpacing volume adjustments, putting pressure on profitability, even if demand softens. For a battered sector, this tariff agreement is arguably not enough to dramatically improve their prospects. While tariffs grab the headlines, the fine print matters equally. First, Brussels has signaled for the first time that elements of its landmark Digital Services and Digital Markets Act could be flexed during negotiations, a move that is already drawing scrutiny in the European Parliament. Second, implementation will be asymmetric. Washington will activate the 15% rate via executive order on the 1st of August, whereas the EU still requires Council sign-off and de facto parliamentary assent. Expect a 6 to 12-month provisional application period. Third, the draft legal text contains a 3-year sunset review and a snapback clause that would restore higher tariffs if either side falls short on procurement, investment, or quota pledges. Oversight will sit with a new Transatlantic Trade Compliance Board designed to arbitrate disputes outside of the WTO and recommend countermeasures within 90 days. Finally, the agreement is almost entirely goods-focused. There is no substantive chapter on digital services, financial licenses, or mutual access to public procurement, issues relegated to a hoped-for Phase 2. Now that the EU has this deal in hand, while it will consume many trade negotiators' time, I am sure that Ursula will continue shopping around to the rest of the globe to find alternative markets, as well as convincing leaders across the 27 nations that this deal is the best that they could achieve with the US. Given that this EU-US agreement was settled in the UK, up in Scotland at the golf resort, we thought we should add a light comment on some recent developments in the UK. In particular, we note a striking divergence occurring in the UK. June retail sales volumes rose 0.8% month over month, marking a second consecutive gain, yet the GfK Consumer Confidence Index fell 3 points to minus 21, its lowest since February. Households appear to be willing to spend when the price is right, helped by discounting and warmer weather, yet they remain nervous about the economic outlook and real income growth. Bank balances have been increasing as they remain uncertain of the tax outlook, given headlines and concerns about employment. For credit investors, the takeaway is that UK consumption is being propped up by excess savings and price promotions. It is not really a solid foundation for a re-acceleration in growth. Keep an eye on future PMIs and the next labor market print to see which signal wins. This is the kind of divergent signals we are likely to see more of over the course of the summer and into the autumn. Now to cover a topic near to my heart, securitization. On the 18th of July, the European Commission published a draft delegated regulation that puts in place the final set of proposed changes for European securitization regulations. The intent of this particular regulation change is to finally make European ABS attractive to insurers. The proposal rewrites Article 178 of the Solvency II rulebook, swapping the old blunt 10% capital hit for senior STS, or simple, transparent, and standardized tranches, for a new sliding scale that starts at just 0.7% for a sub-5-year AAA bond and tops out at 2.3% for a long single-A rated note. Even senior non-STS paper gets relief, A 5-year AAA slice would fall from 2.7% to around 1.7%. In plain English, insurers get roughly a 50 to 90% capital discount, bringing securitization in line with covered bonds in their treatment. The Commission's message is clear. If you're an insurer, run the new numbers now and tell Brussels by the 5th of September whether they work for you or not. If the grid survives the political gauntlet, desks expect a wave of insurance demand for senior STS paper as early as 2026. This should help to support bank and non-bank originators with cheaper funding. It's one pillar of the wider Savings and Investments Union package, but it's arguably the one that could reboot Europe's sleepy ABS market the fastest. Dependent upon the final terms of the regulation after their consultation, overall it is a step in the right direction and should help to unlock capital that will help Europe to improve funding positions versus those offered in the US. Hopefully this reboot of the Savings and Investment Union can be built upon to support ongoing funding in Europe. So, what does all of this mean for investors? Well, as I highlighted at the beginning, day one trading was choppy but on the EU-US trade deal, but the overarching theme is relief. The tail risk of a 30% tariff is gone, and as a result, markets like the iTrex crossover is testing its year-to-date tights. Equities are firmer and the dollar is well bid. Whether the real economy can absorb a 15% tariff remains to be seen, but for now, the base case remains that the US is likely to skirt a recession. We still think that Europe has started a slow turnaround. This trade agreement will likely see some sectors still struggle, such as the auto manufacturers, which will hold back and delay the return to growth. There still remains risk to the downside, and we think investors should be prepared for upcoming economic data results in the months ahead, which could point negative and introduce some volatility. There is still likely some upside to markets from here, though, given the removal of uncertainty before we start to see those results come through. That's all for this edition of the Credit Compass. If you enjoyed today's episode, please follow, rate, and share. If you have any questions or topic ideas, please drop us a line. We'd love to hear from you. For deeper research and credit ratings, please visit us at KBRA.com. Until next time, stay curious, stay informed, and stay resilient. Let the Credit Compass help guide your way.